Investing is hard until you focus on 5 skills. My name is Dr. Amos Nadler. I'm Chief Scientist here at Prof of Wall Street. And today we're going to talk about 5 skills that can simplify investing and make it feel a bit more manageable. And what I mean by manageable is that when you know what the skills are and you know how well you do on each of those skills, it's a lot easier to do a good job as a portfolio manager. So let's dive in. So the first one that gets all the attention here is stock picking, for the obvious reason that the majority of news is around buy this, buy that. That's really the lion's share of information, whether you're opening up the Wall Street Journal or whether you're on Yahoo Finance or Twitter, whatever it is, it's typically around what to buy. And this takes up, as I said, the majority of people's attention, and we get kind of obsessed about what it is I should be buying, which is fine and dandy because, being able to pick future winners can make a very big difference. And there's lots of evidence in the mutual fund literature showing that stock selection of future winners does matter, and the persistence of returns, is partly or largely based on the ability to pick winners. But there are other 4 factors, which we'll talk about in a second, but let's stick with waiting for a second. So if you're investing, you have a choice. You can select individual stocks. You can buy into indices, whether they're diversified, sectoral, or whatever. But the challenge that people have as investors is they don't get good feedback about whether or not they're doing a good job at stock picking. So the way that I thought this would work as chief scientist here at Prof of Wall Street is let's give people easy benchmark to figure out whether they're actually making good decisions with the stocks. So this is what we do. What we do is we analyze your trades and we show you how well you're performing relative to managing the S&P. So this allows us to hold constant a lot of the variables that come up with portfolio management, and you'll get a number, a specific dollar number at how much money you've added to your portfolio through actively managing your specific stocks relative to this common benchmark. The other big skill is weighting or position sizing. This is probably a close second to stock picking, for the simple reason that if you put a lot of money behind good ideas and you don't put a lot of money into bad ideas, which includes the number 0 or a negative number, which would be shorting, then you're probably in a pretty good place. So picking future winners is great, but if you're undersizing those positions, let's say you put $5 on NVIDIA 20 years ago and you put $100 on some bad idea, then that certainly would reflect in the weighting aspect. So the challenge that people have is they don't understand and don't appreciate the importance of weighting, and number 2, they certainly don't have any feedback. And feedback is one of the great sort of debiasers and squashers of overconfidence when you get regular quality feedback. So if you look at it from a weighting perspective, what we do at Prof of Wall Street is we give you feedback on how much value you're adding in dollar terms by oversizing certain positions or undersizing certain positions, and see how that stacks up relative to what's called the 1/n framework. This is not a number I just pulled out of nowhere. This is actually in a lot of papers, and just gives us an easy benchmark to evaluate people's performance against. So if you're doing better than allocating just across the amount of money over the number of positions you have, and you're doing better than that, then you may have some persistent skill. And we've analyzed billions of dollars of transaction data, and we find that some people show persistence, meaning across market regimes, across whatever's going on, they're able to produce more value through sizing positions, whatever methodology they're using, relative to this 1/n. And we find people that's the opposite. So some people would have done better to just have what's called naive diversification, just put in equal amounts across their positions from step 1 from the stock picking aspect. So let's not underestimate the position sizing aspect of it. So let's move on to aspect number 3. So this is dip buying versus loss chasing. We've heard this phrase of dip buying. It means when a price drops, do you buy more of it to seize the upside? There are people who are great at it, and I've seen portfolios where people are able to buy underpriced assets at the right time and take advantage of the upside from that. However, there are also people who do what's called loss chasing. And loss chasing is buying more of a losing position with the hope that it rebounds. And also, and this is a behavioral aspect, is that people not only believe in mean reversion, but they also are trying to erase the loss. So when you're buying something as the price is going down, you're lowering your average cost basis and reducing that sort of disutility of losses by showing, well, I paid X for it, now my average cost basis is lower and I've shown less of a loss. That's not a good idea. That's not like a motivation to buy something. That's not something that would stand up at like an investment committee saying, oh, I feel like crap that I'm down, I'm just going to buy more of it to try to erase that loss. Not a good idea. Furthermore, even when people are right, and I've seen this in lots of data sets, when people start doubling down on these losing positions, sometimes they're right and it skyrockets and it's way up, but then they don't sell anything. And so this portfolio gets heavily concentrated in a losing position. It actually does rebound, but then they don't capitalize on that upside and goes back down. So you have to understand that if you are buying more of a losing position, that A, you are potentially increasing concentration into a bad idea, and you could be doing the opposite. You could be buying more into winning positions, which is more of a momentum style of investing for active managers, which empirically does better. So you as an individual investor, regardless, a portfolio manager, regardless of what I'm saying now, it's best to know. So what you should do is get an analysis. We have this snapshot tool that gives you feedback about whether or not you're adding value through subjective weighting, what we call subjective weighting relative to this like 1 over n. And it shows you in dollar terms how much value you're creating or you're destroying. What our metric shows you is how much money you've allocated into the dip buying strategy and whether that strategy has netted you positive or negative results. As I've said, we've seen people that do amazing in buying dips, and we've seen people that destroy a ton of capital doing that. So which one are you? You should check it out. Okay, let's get into number 4. So selling is another kind of relatively unknown factor here. People don't think of selling as a skill per se, but it's an incredibly important skill. So there's a paper came out 2023 in the Journal of Finance titled Buying Slow and Selling Fast. And it looks at professional managers, and it shows that a lot of effort and performance seems to come from the buying decision, but it's underappreciated how much performance leaks out through the selling side. So put a lot of effort into the buying, and then we sell a bit more haphazardly and miss out. So as you could imagine, I've developed a metric, an algorithm that detects your selling decisions, and it gives you this sub-portfolio performance. Now, what you want to see with selling, what you want to see is everything you've sold like goes to crap. Like you want to see it collapse, you want to see it go down. What you don't want to see is whatever you've sold go on to outperform. That's not what you want to see in people's portfolios, and it's probably good that you get checked out. I've certainly done it on all of my accounts and clients, is you get a clear number on whether or not you're able to sell future winners or future losers. I don't want to think of this as like some creepy way of spying on your ex, but it's like kind of like that. It's like you should probably just not pay attention to that and forget about it if it's an ex. But when it comes to portfolio management, this is actually totally different, because if you're bad at selling, you should know that. And I've worked with people who are actually really, really good, and it's amazing how whatever they sell, it's like the kiss of death. It just collapses completely. And I've also worked with people that don't sell at all. They're buy and hold over long periods of time, and I don't know if it's necessarily from lack of knowledge about the quality of their skill or some other reason. Maybe they're just doing well. But most people do sell, and it's good to know whether what you're selling is helping or hurting your portfolio. Alrighty. Well, okay, so we have to talk about the elephant in the room. So if you Google my name, Amos Nadler, and you put in NVIDIA, you will find tons of stories about me selling NVIDIA as a PhD student. Now, there's a bit of a backstory. So the backstory is that I was halfway through grad school, and I was teaching at the Claremont College's behavioral finance. Now, I don't know about you, but I get a bit, frustrated when I have professors who are pontificating about something that they've never actually done as a practitioner. So that's pretty common in academia. I get that. But when it comes to finance, I feel like the least you could do is put some skin in the game. So that's what I did. I took out student loans, low interest rate, don't worry, it wasn't crazy leverage. And I started investing in an account that later turned into E-Trade, which we'll talk about some other time. Because I wanted to have some battle stories. I want to walk into class with something exciting to say, something about, sorry, it is hot here today. So I bought NVIDIA at like split adjusted, under 30 cents, given splits. And then I sold it at some gain. It was something like 50 or 100% gain in a short period. And I thought I was some sort of genius. I thought, I'm amazing. I was able to turn this profit, so quickly. The stock market is easy. It's easy for me at least. And I thought it was great. Fast forward to as the years go by, and those shares that I sold went on to perform around 30,000%. So about a 35,000% return on the shares that I sold, worth millions of dollars today. So I agreed to do an interview about this. I think it was on MSNBC or something, but if you Google it, you'll find lots of information on it. I did a video with Dan from University of Chicago. We talk about our biggest mistakes. So I sold one of the biggest winners. Now, not all. I still have shares. I still have that on, to brag about, but like the material wealth that I set on the table was at that point. I didn't know the difference between trading and investing. It was like one of my first trades ever. And it's a hard lesson to learn. But the good news is now we can stop people from making these mistakes. Now, if you can differentiate risk aversion, which is, oh gosh, this thing has gone up in price, and now I feel uncomfortable, and that discomfort is the signal I'm using to tell me whether I should sell, which is not a trade signal, it's just an emotion. If you're doing that, then that's a mistake, which can cost you, as it did to me, through the invisible portfolio diagnostic. So it's good to know whether you're good or bad at selling, and it's sort of easier if you're really good or really bad, because those are something you can work with. Some people are in the middle and there's sort of a crossover, but the least you could do is get your portfolio diagnostic at Prof of Wall Street. There's a link below. Let's move on. So the fifth skill is managing winners and losers. So if you are an active manager, and I'm not promoting it or saying it's a good or bad idea, but if you're actively managing winners and losers, you have to be able to know whether you're doing a good job. Now, the idea hit me when I was again in grad school, and there's a paper called "Are Investors Reluctant to Realize Their Losses?" It's by Terry O'Dean, UC Berkeley. Very cool guy, by the way. A big fan of Terry. And in this paper, he showed that retail investors do indeed sell winners too soon. So just like I did with NVIDIA, and they don't sell their losers fast enough. They don't realize those losses. They just sort of carry those losses on the books. So what does that mean? So that means that we're leaving money on the table by selling winners that go on to outperform, and the capital that's staying locked up in these losing positions keeps going down. So we keep decreasing our capital base, or rather the value of those positions. So if you imagine to do the opposite, like the against what your gut is telling you to do, cut those losses, just take the hit, and then fund your winners, you would actually have more of a momentum move and would have outperformed the kind of gut strategy of trimming your winners and watering the weeds, so to speak, by putting more money into losers. So the disposition effect is like a critical factor for active managers, and you may or may not have it. Some people do, some people don't, and it's good to know what the actual dollar figure that would be that you're incurring as a consequence of managing your portfolio actively through the disposition effect. So that's pretty much, those are the 5. I'll do a quick recap. So the 5 skills that make investing, I would say, a lot more manageable are stock picking. So the positions that you're picking, how are they performing? How are you weighting those individual positions? Are you able to put money behind future winners and less money or no money behind future losers? We also want to know the quality of your selling decisions. We want to know whether what you're selling drops in value in the future or it increases in value. Because if the stocks that you're selling actually increase in value, it's best not to sell or even add to that position. And I can think of clients we've worked with now. By the way, I've analyzed billions and billions of dollars worth of trades. I've gotten a really good handle on individual differences, and it's fascinating to see this because people have this sort of signature DNA in it. And there's one client who very sophisticated entrepreneur, does very, very well financially, and everything that he sold has gone on to outperform his portfolio massively. And the motivation for selling those was needing cash. Great. But what was interesting was the persistent pattern of those going on to be huge winners. So if you need capital, that's a very expensive source of capital. So understand whether you're good at selling or not. And then we'll go on to dip buying. So dip buying versus loss chasing. If you have capital and you deploy it into stocks or assets that have dropped in value, you need to know whether you're actually good at identifying opportunities versus, and I know this is a horrible phrase for anybody, especially in the kitchen, is catching a falling knife. It's quite a searing kind of idea that you're catching something that's actually going to make you bleed out versus capturing an opportunity and then seizing on that upside. Get checked. I feel like this is like a PSA for some sort of health screening, but it's actually not that different from a health screening. You need to know the health of your portfolio. You have to know how good you are at these specific skills. And once you do, life becomes a lot easier. So back to the recap here. All right, so we have done selling. So selling was the one we talked a lot about, was the quality of sell decisions. And then certainly managing winners and losers, that's a disposition effect. Thank you, Terry O'Dean, for that paper that gave me the original spark to build these algorithms and build these tools and platform ultimately that helps investors do a better job. So I offer this free snapshot that you can access. There's a link below. and also coaching for primarily portfolio managers and high net worth investors. But I'm always happy to chat. Again, I'm Dr. Amos Nadler. I'm Chief Scientist at Prof of Wall Street, and it's been a pleasure talking about the 5 skills that are helpful for investing. I'll see you soon.